Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 113. We got a lot going on this episode. We have Jerome Powell, we have the companies reporting, we have political uncertainty, and we're going to talk about something we haven't talked about a lot, which is fixed income, bond investing, and how rising interest rates and companies' rising cost of debt can impact the way that you invest and set your portfolio up. So, get your mind right. Let's get to work.
You dropped this.
Welcome back to the show, everybody. Another episode here. Not a great week for the stock market. There's a lot of concern out there, a lot of worry, political unrest in Israel, Ukraine still, President Biden asking Congress for money. We still don't have a Speaker of the House. We're starting to have companies report earnings. We had Tesla this past week. We had Netflix, some of the banks, Goldman Sachs, Morgan Stanley. And so you look around, there's not a lot of good news out there. There is not a lot of good news. And so, when you're looking at your portfolio, it probably hasn't looked good the last couple of weeks, really since the end of July. The NASDAQ is still up 24% for the year. We have the Dow Jones barely negative. I mean, like 0.06 negative as of Friday's close. S&P 500 still up 10%. But when you look at kind of just the outlook for the market right now, it just does not look that great. There's just not a lot of things to be excited about. Netflix had good earnings. They were one of the bright spots. They had been beaten up handily before they reported this past quarter. They had good subscriber growth. But you look at Tesla. Tesla, obviously, they've been lowering the price of the vehicles, which is going to shrink their margins, makes them a little bit less profitable. I think later on that will come back and be a benefit to them. But Elon Musk suggested that the economy isn't as strong as people think. But when you look at the data, consumers are still spending. And so you have Jerome Powell come out and, the Fed's basically saying, hey, we're going to stay here. We're going to stay at this high level for interest rates. And until we start seeing things happen, we're going to keep them here. We're going to make sure that inflation doesn't come back up and get out of control. And so it really is just kind of this no man's land for the market right now. And as an investor looking for opportunities, it's a little bit difficult. It really is a little bit difficult. I think over the next maybe year or so, I'm really not sure how the indexes are going to do. And by indexes, I mean S&P 500 index, Dow Jones, maybe the NASDAQ will. But I think you're going to have to get better at looking at specific companies that are going to be able to kind of navigate this interesting time that we're in, and really just kind of let that help you build a framework for the kinds of companies that you want to invest in. And so I think back to COVID, when I was looking at and kind of changing portfolios during COVID, I looked at defense companies because defense is always funded. I looked at consumer staples. I looked at technology, and I looked at pharmaceuticals for obvious reasons. Right now, I still think technology companies, I still think defense companies are good. Consumer staples, for the most part, they've been weak this year as well. Go look at the charts of Coca-Cola, Hershey's, Procter & Gamble. A lot of these kinds of companies really have not had a good year. Oil hasn't had a good year. And so, you're looking around and you're going, man, maybe this is, we had a good first part of the year, but maybe the back half is going to be pretty average. And so you look around, and I read a lot of things, and there's a couple things I wanted to point out to you to just be mindful of. Barron's came out with a really good article this week talking about how borrowing expenses for companies are starting to rise, and there are some companies out there that are really short on cash. So they point out WeWork, they point out Sleep Number, they point out Children's Place, but they're looking at how much cash do these companies have on their balance sheet? And then you look at their short-term debt. So when you look at a company's short-term debt, that means that they have that debt is due within the next year. Okay, so if a company doesn't have a lot of cash, but they have this massive amount of short-term debt that they need to pay back, well, they're going to have to borrow money from a bank or somebody to do that. And so there's some companies that are going to get in real trouble. So when you have interest rates as high as they currently are, and you see like mortgages, all of these things where it's 8%, car loans at 7%. I mean, the same thing happens for a business. So a business approaches a bank and they're going to be borrowing at a much higher level. And so that cost of capital for a business goes way up. And if the company hasn't been doing well, if their sales, their revenue hasn't been doing well, it's going to be difficult for these companies to be able to borrow money when banks look at their balance sheets and go, I don't think you have the numbers here to be able to do it. And so, looking at these, when you look to invest in a company, you really have to pay attention to that balance sheet. You have to pay attention to the cash that they're bringing in. Are their margins shrinking? Do they have cash to pay back their creditors? And so that really leads me to this conversation about fixed income. So fixed income is not talked about a lot when it comes to investing. Well, in most places, it's not talked about a lot. And the reason for that is fixed income is kind of boring. Bonds are kind of boring for the most part. Everybody wants to talk about stocks. They move every day, all of those things. So that's the conversation. So a bond, though, is a contract between you and the person that issued the bond. So let's say it's a company. Let's say it's a corporate bond. That is a contract between you and that business. They're going to make coupon payments to you, which is kind of their payment to you for using their payment to you for using your money. And then at the end, at maturity, they're going to give you that money back. Well, if a company, isn't as strong as another company, they're going to have to pay you more. They're going to have to pay you a higher interest rate in order to be able to borrow money from you. And so I'm kind of parlaying this with this article that I read from Howard Marks. So Howard Marks helped found this company, this investment firm called Oak Tree Capital. And he was kind of a fixed income expert. And in this, he does these memos to his clients. You can go look them up. They're fantastic. And he discusses, the market and is it changing? And we look at this and how do things look versus how they used to look? And he points out that from 1980 to today, if you worked in the investment business, you worked in a time where interest rates were dropping, right? And so you look at the amount of wealth that was created in the 80s, 90s, the early 2000s was not a good decade, but 2010 to 2020. And, how much of that was companies, but also how much of that was having this wind at their back of low interest rates or interest rates that were being lowered. And he makes a good point. He talks about how if you're in the investment business and you started out after 1980, that you've never really had to work in a rising interest rate environment. And so you'd have to be in your late 60s in order to remember this or have started your career basically in the mid 70s or early 70s to really remember what that was like. And of course, this makes alarm bells go off in my mind because I'm always thinking about blind spots that I have or things that I can improve upon or what are some areas that I wish I was better at. And so through reading this article, he talks about how fixed income should be kind of a more of a priority for, your portfolio and kind of how you develop things. Well, if you look at kind of older or the kind of portfolio development of the past, they would always talk about a 60-40 portfolio, which is 60% stocks, 40% fixed income, bonds. And that has kind of gone away over the last 15 years because with interest rates close to zero, nobody really wanted to lock their money up at a low interest rate for a long period of time, which is what Silicon Valley Bank did, and we kind of know how that turned out. So the 60-40 portfolio kind of went away, and this acronym called TINA came out. So the acronym TINA stands for there is no alternative, right? There is no alternative to stocks. If I need income, I need to invest in a dividend paying company because there's no other place I'm going to get that. When interest rates are close to zero, your savings account's paying 0.01, bonds are paying 1% for a long period of time. It's really not worth it to lock your money up into those instruments. And so there's a lot of income investors that basically invested in the stock market that normally would not have if interest rates were at a level where they could get paid to provide current income for them and their families. And so now we're seeing where that is actually possible. You can do a CD right now for 5.4%. And so there's a lot of money going into the 2-year treasury, maybe the 10-year treasury, definitely going into 6-month, 1-year CDs. And that takes a lot of money out of the stock market. And so the stock market is kind of plateaued here because when you look at, okay, we have a war in Ukraine going on, we have, the stuff going off in Israel. It is very difficult with the presidential election next year and all of these things going on where you wouldn't just say, you know what, I'm going to park my money on the sidelines for a little bit. And I'm just going to see what happens. I am just going to see how this goes. And you know what? I'm going to check on this in 2 years, and we will see what's going on, and I'll reevaluate things there. But back to Howard Marks's his memo here is he discusses that there are opportunities in fixed income. There are some bonds that have been beat up. Last year was the worst year for bonds in 100 years, and so. You look at that and you say, wow, like there could be some opportunities there. So it's one of the areas that I'm researching. Is looking at some of these higher yield bonds, maybe some companies that are in trouble, but I'm looking at just different opportunities that are out there on how to put these things back into people's portfolios. And so it's just something that I think deserves a little bit of attention. And there's just... again, like I said in the beginning, a lot of discussion goes around stocks, but not that much attention kind of goes to fixed income, even though the bond market is much larger than the stock market. There are thousands upon thousands of bonds out there, and there's some that you should be aware of. There's corporate bonds, which corporate bonds are issued by corporations. There's municipal bonds that are issued by municipalities, and those typically pay tax-free, which is why high net worth individuals like municipal bonds so much. There is government-backed bonds, which is, the T-bill and things like that, where, that kind of looks, when you're doing investment calculations, you look at that T-bill rate, and that's kind of your risk-free rate, right? We consider the U.S. government, they're going to be able to pay their bills, which I know that's a whole topic for another day. But we look at them and say, okay, they're going to be able to pay their bills. So the Treasury bill, what the U.S. government is going to pay, that's considered the risk-free rate. And so when you look at investing in anything else, you have to be compensated for the risk that you're taking. So if you can get paid 5.4% for doing nothing, well, then you got to be pretty sure that the other things that you're going to be able to do are going to be able to pay that back, And so it makes this inflation conversation so difficult because if a company is having to borrow money at 7 or 8%, well, then they got to get a better return on that money in order to make that worth it for them. And so they either have to raise prices or they have to cut expenses or their margins are going to get pinched like Tesla is currently happening, where they're going to end up making less money. And so it just makes the environment not look as good. It doesn't mean that it might not be better in 6 months, 9 months, a year, or whatever. But in this transition period, I think that we're going to kind of stall out here a little bit until some of the things that are going on around the world and in the U.S., until some of this stuff is ironed out a little bit. And so it doesn't mean that you can't invest. It doesn't mean you can't just, I just keep doing what I'm doing, but we have to temper our expectations a little bit until we see new information that allows us to be able to make that change. And so you can look at fixed income. There's some bond funds that provide fixed income, and you can kind of check on those and see what those look like for you. One ETF that's popular is, let's see, what is this? Vanguard Total Bond Market Index, BND. Yeah, it's okay. It has not done well over the last 5 years. So remember, when you look at these charts, when you look at ETFs for bonds, they're not going to look great. I mean, last year being the worst year in 100 years, as I said before, it really makes it to where it does not look good when you look at the charts. However, if you're in the spot to be able to buy individual bonds, and most individual bonds, the minimum is $1,000 if you're going to buy your own, like an individual bond. But being able to go in there and see some of the ones that have been beat up, some of the high yield bonds, as long as you can go in there, look at the companies, assess the balance sheets, see if they have enough cash to be able to pay back the bondholders. That's the beauty about bonds, is you don't have to really worry about, is this company, are their sales going up, all those kind of things that you would if you were a stock investor where you're looking for appreciation of the stock. With a bondholder, it's a contract. The company has a contractual obligation to pay you. So as long as they have enough money to pay off their debt, then you should be okay, as long as they have enough cash flow to make that happen. So since it's a contract, if they're making money, they have to pay back the bondholders first before they can, that's part of their cost before they look at their retained earnings and what they keep in the business or what they pay out to shareholders in the form of dividends or repurchases or whatnot. So there are some opportunities out there. I've been investigating them for the last week, looking at some of them, trying to decipher what is risky, what's too risky. Some of the commercial real estate ones that are out there, based on some of the past episodes, if you've listened to them, I'm worried about commercial real estate in the next couple of years. So I probably will stay away from those. But some other companies could possibly present some opportunities. And so when you look at if they're trading at a discount, meaning they're underneath their par value of 1,000, there might be some opportunities there. And that kind of gets real granular. So it's really kind of difficult to discuss that just with words and without kind of being able to write something down or talk to you about it in person. But something worth exploring for sure. And I think, if interest rates really do stay higher for as long as people are expecting or as long as the Fed is expecting, then this is going to be an area that you're going to want to be educated on, because it is going to become part of, your portfolio in the future. And we might get back to that 60-40 area that we discussed, where that might come back into favor in the investing community. So, I'll try to do a little bit better job. I don't think I really framed this out as well as I wanted to, but it kind of gets the point across a little bit, and it kind of plants the seed for this kind of discussion in the future, to kind of maybe take a more in-depth approach to how to go about finding some of these. Bonds are a little bit harder to find than stocks. Obviously, you can go to Yahoo Finance and type in ticker symbols and look up stocks. Bonds, it's a little bit more, it's a little bit tougher. So depending on where you have your investment account, you can go in there, you can look under fixed income. It's normally got a way for you to search them. And so you really have to be kind of knowledgeable a little bit to know what to search for. But if you're looking for like a CD or something, it's not going to be that hard. So anyways, just kind of opening up that topic, and we'll kind of see where that goes. But again, the market's not always going to look good. The outlook is not always going to look great, but that doesn't mean we change our habits. That doesn't mean that we change our investments. As far as putting money back, paying ourselves first, investing, believing in America, believing in commerce, believing in entrepreneurship. And so, you got to put money back, put money in your 401k, put money into your investments, and just kind of believe in that it's gonna that it's gonna work out in the future. So let's see. This next week we have a big week for companies reporting. We have Amazon, we have Microsoft, we have I think Google is also reporting. So there's going to be a lot of activity this week based on what those companies say, how they did the previous 3 months, but also how do they expect the next 3 months to go. Because obviously, like Amazon's quarter coming up, the fourth quarter is their most important quarter of the year. So we'll get to kind of hear a little bit about that. And we'll be able to discuss that next week. So I hope you have a great week. Don't mistake activity for achievement, and I'll see you next time. Thanks, everybody.